Welcome back to another episode of the Pursuit of Progress podcast. Going to be doing a new format today, which Ben and I are both really excited about. We're going to be doing a lot more of a deep dive on practical, real life stories and just examples of real estate investing. So, this episode today is going to be a first of several part series. So, Ben and I are really excited to share this with you. We're going to jump right in today. We're not going to do all of that chit chat and waste your guys' time. You know how we're doing. We're doing great. We're enjoying summertime. So we're just going to get right into it. Ben, I'd love for you to just say hi to the audience and then kick this off for us.
Yeah, well, hello everyone. Great to be back. Love talking real estate, and I wanted to start off with an article from Yahoo Finance. It talks about buy real estate in these 10 cities to be rich in 10 years. So, what are the cities referenced in the article? Well, these are the 10 cities referenced in the article: Boise, Idaho; Fort Wayne, Indiana; Las Vegas, Nevada, and these are in no particular order: Seattle, Washington; Colorado, 5280 Denver, Colorado; Raleigh, Durham, North Carolina; Austin, Texas; Charlotte, North Carolina; Phoenix, Arizona; Nashu, New Hampshire. Now, here's what it says about Denver, Colorado. I know a lot of you are from Denver. The Denver metro area has witnessed a substantial surge in population over recent years, primarily driven by the expanding job markets and its captivating natural landscape, making it an appealing destination for holiday weekends. As of January 2023, the median listing price in Denver stood at $565,000, indicating a year-over-year upward trend of 6.6%. Furthermore, the median listing price per square foot was reported at $355. Apart from its strong economy and thriving job market, Denver continues to attract real estate buyers due to its advantageous location, close to major cities such as Boulder, Fort Collins, and Colorado Springs. This central position enhances its desirability among potential investors, further bolstering its prospect as a lucrative real estate market.
Interesting. I didn't hear any, I missed one, but was there anywhere on Texas or Florida on that list?
I believe Austin, Texas was on
Or
there.
Austin. Okay.
Yeah, so Austin, Texas, but nothing from Florida.
I'm kind of surprised.
Florida was not on there. A market that I love that's not on here, and you know this, is some of the Midwest Sunbelt markets. A market that I personally invest in addition to Denver and Arizona, is the Tulsa, Oklahoma market. So I think this, just reading through those cities, this is a lot of bigger cities, a lot of bigger metropolitan areas. So maybe it was over a certain population size. But you're absolutely right. There are opportunities out there, and that's what we're going to talk about today. What makes sense? What type of properties are out there, and how do you identify the correct market and the correct?
Yep, I agree. That's before we move on just on that list, I was just thinking through that a little bit more. I mean, we have been just over the last couple of years just so frustrated with the barrier of entry with cities like Denver, just with investment properties and how you need $1 million just to buy a duplex out here, whereas like you were saying in Sunbelt states you can buy a fourplex for $250,000 sometimes. So that is very surprising that some of those cities like Austin and Denver are on that list that are just so expensive these days. So yeah, we're definitely going to go through a lot of this in more depth, guys, and just share why we're talking about, what's a good place to buy, what isn't, some of these different criteria that we use when we start helping our clients and also ourselves identify good investment opportunities.
Yeah, and that's a really great point. When it comes to investing, there's a lot of different factors that you can look at and a lot of different ways to make money, right? There's equity appreciation, the value of the property increases over time. There's also monthly cash flow. And what's more important than, is one more important than the other? And the way that I always answer that is they're both important in my opinion. I want to be able to identify things that have room to appreciate while they're also going to cash flow. So I would, I would have a tendency to agree with you. Of course, I'm very pro Denver, Colorado, and so are you because, we live and work here. But from an affordability perspective, because home values are so high here and interest rates are high, making the cash flow numbers work are a challenge just because of those affordability concerns. Rents have not quite caught up the higher home values and the higher interest rates. So it can be a little bit more challenging in markets like Denver versus some of these other markets that are lower priced, like Tulsa or Tucson or some of these other Midwest and Sunbelt markets?
Mhm. And I have a couple comments to that, but I'll save it for when we get to this part of the kind of list that we've prepared on these different kind of principles. So you always over the
Save it,
next.
but don't be shy
I won't be
when
shy,
you're
I
gonna open
promise.
it. Okay.
So we're going to be, again, going over several different criteria, different kind of bullet points that we've set up for just having a very thorough, well-rounded understanding of what it takes to really be educated and making a mindful decision that's not going to put you potentially into a tough predicament a few years from now. So we're going to talk first just about just the understanding real estate investing basics. And when we're talking about real estate investing, we are talking more about a not your primary residence. We're going to be talking on this next couple episodes more about just, investment properties. So, there are obviously opportunities to, buy a fixer upper house, live in it yourself, some of those types of strategies. And we'll touch on that. But again, this is really just going to be more in depth on investment properties. So Ben, why don't you just help us just start off with just a few of the main kind of the types of investment properties that are the most common nowadays?
Yeah, that's a great question, and that's what is great about real estate. There's not one way to win in investing. There's not one type of property that you can invest. There's a multitude, and really, one of the most important things is identifying what type of property that you want to go into and identify. The first would be multifamily, and I know from your experience, you're really an expert on this, but there's different classes in multifamily. In multifamily, the definition of that is really going to be anything over 4 units. Now, a lot of multifamily can be anywhere from 10 to 100 or several hundred units. And it just depends on the type of property. But there's different classes in multifamily. There's class A, class B, and class C. And I believe, correct me if I'm wrong, that those classes are relevant to the overall condition of the property. Is that correct?
Correct. Yeah. Condition, a lot of times they also correlate with the age of the property, but yeah, more or less it's just the overall quality of the property. So class A would be, a brand newly built development, maybe downtown or somewhere that's pretty high traffic, high exposure, newer amenities, clubhouses, pools, gyms, pet spas, all of the kind of bells and whistles that a lot of the newer the newer multifamily developments are putting in just to set themselves apart from the class B and C to really kind of create a little bit more of a value add for their residents, their tenants. Class B is kind of one that's not quite as common, in my opinion. I think in
Yeah.
most bigger cities, you're going to find a lot of Class A, and then you're also going to find a lot of Class C. And the Class C is
Mhm.
what I was really involved in for several years. And Class C is typically in Denver, at least a 19 property. Definitely, probably a few, outstanding capital improvements that need to be made. So maybe the roof sold, or maybe there's just exterior painting and siding and just different things that aren't necessarily being kept up to the same standards as a brand new Class A type property.
Mhm.
Um, but obviously, each of these types of classes have opportunities. So there's actually also
Yeah.
Class D, which is basically like almost uninhabitable. But I think that different experiences that I've had over the years with mentors and just seeing people be successful in multifamily, I think one thing that I'll just share with people is it's really important just to kind of find your lane and then go a mile deep versus, just being kind of surface level and understanding everything, really
Yeah.
understanding whatever that is that you're wanting to get involved in. So if it's class C, you need to be a little bit more educated on, having good connections with construction crews, renovation crews, really understanding the costs associated with making those types of improvements. Whereas with, for example, class A, you're probably going to need to find some other investors to go in on it with you. It might even be more of like a, more of a accredited type investment opportunity that's got several people involved in
Mhm.
some sort of a fund or some sort of a collaboration. So, there's a lot of differences when it comes to the A, B, and C.
And what would, for example, you mentioned the Class C a lot of times needing some capital improvements. From a real estate investing perspective, what would make that attractive? Targeting a Class C, something that does need capital improvements, is the fact that you can improve the property? Is that one of the?
Yeah. So we'll go a little bit deeper into this in a second because I want to get your kind of expertise when it comes to just how different types of loans are established for investors. So, for example, if you're buying something that's a one, two, or three, or four unit, so a very small multifamily
Yeah.
investment, that's going to just require a standard traditional style of financing, assuming that you're getting
Hmm.
a loan for it. And what I mean by that is it's still going to be, they're going to be valuing that property just off of the same way that you would a single family home for the most part. It's just going to be the property itself, the condition of the property, that kind of stuff. Once you get above four units into medium or large multifamily, as opposed to the traditional style of valuing the property, now it's going to be more on an income based approach where you have so much more opportunity when it comes to rent growth. And rent growth is just the ability to purchase an investment property, ideally that's been under charging their tenants, or you just see an opportunity to, you know, make some improvements, add some value add, and then be able to rent to new tenants at a higher monthly rate. By being able to really create that rent growth, that substantially affects just the overall value of the property. So the real
Yeah.
opportunity, like Class C type multifamily, is just finding these different types of properties that really have improvements that can be made that aren't going to cost a ton of money, but also are going to add significant value to the renters, just
Hmm.
perspective of what they're paying per month in rent.
Yeah. Yeah, that's so interesting, and that's one of the big differences between the large multifamily, small residential, which is anywhere from 1 to 4 units, and then the traditional single unit is the valuation. And when you have the commercial properties that are the large multifamily, the value of the property is really a function of what the rents are and what the what essentially what the net income is. Whereas in a residential approach, it's going to be more based off of what are the recent sales for other like properties. And you touched on this just a minute ago, but some other type of properties that are great opportunities for investors. We just touched on the large multifamily commercial properties, but you also have small multifamily residential, and that would be defined as 1 to 4 units. Anything over 4 units is then, falls into the commercial category. What's great about the 1 to 4 unit is that it's still eligible for traditional Fannie Mae, Freddie Mac financing. So you can actually get a traditional residential mortgage on a small multifamily 1 to 4 units. And then, of course, you have the traditional single unit. Uh, one unit, whether it's a single family residence, condo, townhome, and then there's also different ways to rent these properties out. You can do traditional leases that are long term, 12 to 24 months. You can do medium term, which would be more 6 to 12 months. And then you can also do short term, short term vacation rentals. What I do personally, I have properties that I do short term on. I have properties that I do medium term on, and also properties that I do long term on. So it's finding the right strategy for the right property. And what you said, as long as you have a vision and you identify what your strategy is going to be, there's a way to win with all these different property types and different strategies.
And before we move on, just one other little nugget of info I want to share with the audience. And I think you would be better than me to just go a little bit more in depth on this. But at the beginning of this year, 2024, Fannie Mae, Freddie Mac, they did a adjustment also where instead of needing 20% down for the 1 to 4 unit small multifamily, I believe now it's as low as 5% needed down as the down payment. Is that correct?
It is correct, yeah, and it was so exciting because before, if you were gonna buy a multifamily, you could, and let me clarify, that's if you buy it as a primary residence. So if you buy it as a primary residence with the intent to live in one of the properties, say, for example, you were gonna buy a 4 unit, well, you can buy a 4 unit with intent to occupy one of the units, and at that point, you have the option of putting as little as 5% down on that property. Now, it does need to cash flow. Those other units do need to cash flow, or you need to qualify, have enough income outside of that. But before the minimum down payment on that exact same scenario was anywhere from 15 to 25%, depending on the scenario. What's great about that is if you can find a property and it makes sense and the numbers work, you can get into a multifamily with as little as 5% down, which is freaking amazing.
Yeah, I think just when I when I think back to all the different just people that I've encountered over the last decade or so, when I've really started to be interested in, small multifamily investing, I would say, 75% of the people that have been successful have used that strategy. I feel like unless you're,
Mhm.
a family, or, if you have certain circumstances where you just really don't want to be living in a place where you're going to have tenants surrounding you.
Yeah.
But if you're in your 20s or 30 or whatever age, but just if you're in a position where you're really willing to make a small sacrifice to live in a place like that, and you can still find one that isn't going to be incredibly encroaching on your privacy. There's 4 unit type scenarios where you'd still be somewhat detached from your tenants, but just really taking that approach seems to be one of the easiest, just kind of first steps into small multifamily investing is that route. Living in one
Yeah.
unit, renting out the rest, and then ideally having the renters from the remaining units also paying not only your mortgage, but allowing you to live for free and then hopefully save money to then roll that into whatever the next investment might be.
Yeah, I mean that's exactly right. We just talked about affordability and how big of an issue that is right now. And if you can go buy a multifamily unit and live there and essentially have those other units either subsidize or pay for your housing completely, and then if there's money left over, well, now all of a sudden your earned income that you're earning, you can save all of that. You don't have any housing expense, and then it just allows you to, build that nest egg back up and get ready for the next one. And guess what? After 12 months, you can go do the same thing. You could leave that fourplex that you lived in, go buy another one, rent out the departing unit that you had, create another source of income, and then go buy another multifamily doing the exact same strategy. So that's what is exciting. And it's a lot of times there can be some sacrifice involved when you're starting out. And I know that, you've made sacrifices. I've made sacrifices. Looking back on my real estate journey, my first home that I lived in Phoenix, Arizona, it was not a wow home. It wasn't even in the best area of town, but it was all that I could afford at the time. And it gave me the opportunity to start building some equity. I only put $3,000 down because that's all I had back in 2010. And I sold that property 4 or 5 years later and I netted around 70,000. Well, all of a sudden now I have 70,000 to go roll into my next property. And that's just how you get started. So when you have some discipline and when you have a long-term outlook, both of those things factor really, really well with real estate.
Mhm.
Time, properties are going to continue to appreciate. And then this is the other thing that, we always focus on properties appreciating. I never hear nearly as much conversation in real estate about rents appreciating. But you have to keep that in mind that rents are going to continue to appreciate. And that's one of the advantages of being on fixed rate debt. If you're on a 30-year fixed, that mortgage payment is going to stay consistent. But over the course of 10 years, those rents might double or triple.
Yep. One last tip I'll share on just the sacrifice piece of our topic right now is, so I haven't been too involved with the small multifamily myself with investing in fixing and flipping or that side of the small multifamily, but just several homes that I've kind of fixed up myself over the last 10-15 years. Even if it's just a single family home that you're purchasing and you're living in it as your primary residence, you can kind of
Mhm.
apply that same idea to a small multifamily where maybe you buy a fourplex and you live in one of the units. If it requires some significant renovations, forcing yourself to live in that environment is going to make you make those improvements. If you're doing a lot of the work yourself, it's going to motivate you to get that done so much quicker if you're living in that on a daily basis, as opposed to, maybe it's a house that's 5 or 10 miles from you. And, on the weekends you go over there for half a day and all of a sudden, life happens and you got other stuff going on and it's been a month and you haven't even been over there. And, the renovation timeline expands longer and longer. Just when you live in that kind of chaos of,
Mhm.
a home that needs to get improved and renovated, it's kind of a way to force yourself to, get it done quicker and just be a little bit more productive. So it's
Yeah.
a little trick I've had to do a few times and it's worked.
I'll share a story on that same note there. The very first home that I ever bought, and this was before my first home, that was a primary residence that I was just discussing. I lived in Phoenix at the time, and I bought an investment property. It was a distressed property in Tucson, Arizona. It was a pre-foreclosure. And so I went down with a partner and a buddy of mine, and we bought this place, and it needed some work, just like you're describing. The flooring needed to be redone, the entire interior of the home needed to be repainted, but it didn't need a lot of work. Just kind of redoing the flooring, repainting the interior, cleaning some things up. I'm doing some minor improvements with the cabinets. And, this job, had I hired professionals, would have taken maybe a week. But me and my buddy, in an effort to try and save some money, we were driving from Phoenix to Tucson on the weekends and trying to do all this stuff on the weekends, not really having any experience with any of this. And what would have taken a week job turned into about 5 months. And this was also right when the real estate market started to turn in 2007, 2008. And so we ended up being lucky to get rid of this thing right as the market shifted. We sold it for more than we paid for it. But when you consider the amount of time that it took, the mortgage payments that we incurred, and then some of the expense and the realtor fees and everything else, we ended up losing money. And so my takeaway from that was exactly what you're saying. Have much more urgency, depending on what your goals are. If you are going to flip it or if you're trying to get out of it fast, really get the work done with an urgent mind frame and either do it yourself. If you're going to do it yourself, then do it. But if not, then go hire professionals.
And the other expense that you didn't mention is rent loss. So, that 5 months that it was just sitting, let's just say you could rent that out for $1,500 a month. All of a sudden, you've got $7,500 of, lost potential income that could have been brought in to
Mhm.
offset some of those costs, maybe to pay a professional to do it as opposed to doing it yourself. So definitely food for thought. Every
Yeah.
scenario or, situation is different, but good thing to think about.
Yeah, that's right. Live and learn. So learning from your mistakes is so important. All of us make mistakes, but are we actually learning from them?
And then the other kind of point we want to talk about on this episode, and then again, guys, we're going to kind of go deeper into all these other follow up points over the next few episodes of our podcast. But the second point we're going to talk about on this one is just kind of understanding what the goal is with this investment property. So really setting your investment goals and having those be specific to every single investment because everyone is different in different things. So Ben, why don't
Mhm.
you share a little bit more on this topic?
Yeah, I think that's so important. I think you want to, figure out what is your objective, what is your strategy. The reason that's so important is because, if you're looking to do something that's more short term in nature, well, there are going to be certain markets that you're going to want to avoid, and there's going to be certain markets that you may want to target. And so that's one thing that I always ask myself first. What type of strategy am I really trying to focus on here? Is it short term? Is it medium term? Is it long term? When I started my real estate journey, I started off in the short term vacation rental world, meaning that I'm renting out vacation homes and Airbnb, VRBO. And I started doing that in Arizona. Arizona is a great place to do that because number one, it's very pro host or it's very pro short term vacation rental. There's not a lot of city, county, or state regulations. A lot of states and counties hate short-term rentals. Denver, for example, has a lot of restrictions. Arizona does not. So it's very pro short-term rental in the entire state, both Phoenix and Tucson. And I wanted to identify a place that there was a lot of tourists, people coming and going. I wanted to make sure that there's a lot of different types of amenities. There's a university down in Tucson that has incredible golf. It also has the world's biggest gem show. There's a lot of snowbirds that come down from the months of November through April. So it has all of these characteristics, the market that makes it a really strong short term vacation rental market. And so that's where I started. And then as I grew my real estate portfolio, there I would say that there is a little more risk with short-term vacation rentals because it is based more on how the overall economy is doing. If the overall economy is very strong, you're going to have more traveling, you're going to have consumers wanting to spend more, and that plays really well into, short-term vacation rentals. But on the flip side, you don't want to, as I build out that portfolio, I now wanted to start hedging that. And I wanted to have some long-term strategy, some long-term tenants as well, just to hedge the short-term vacation rentals. And so I wanted to find a market that had really strong rents compared to what the rent to own ratio and what that would look like. So I identified Tulsa, Oklahoma.
Mhm.
And the fact that you can buy a duplex in Tulsa for 200,000, 185,000. I mean, I bought several duplexes out there for under 200,000. And even today, right now in 2024, it is possible to get a duplex out there for around 200,000, and the rents most of the time compared to the cost of the home are very, very strong and very favorable. It's a great strategy. It's a great long-term market, and there's also a lot of room for equity appreciation. So in my world, I have my short-term vacation rentals, which are short-term in nature. Now I have my long-term properties. They kind of hedge each other. They're on opposite ends of the spectrum. I also do some Section 8 stuff. The short-term vacation rental, none of that is ever guaranteed. You have to wait until the bookings, the reservations come in. But the Section 8, which is the government housing, well, that is guaranteed. You get paid no matter what. And so that money is guaranteed to come in as long as, whatever that lease term is. And so it's just finding different ways and different strategies to reduce risk, but also I have some stuff that's a little riskier. Potentially I can earn a little bit more, but in case this market does turn, I have this over here, not quite as risky, less risk, probably less reward, but they offset, they balance each other really, really well.
Yeah, the only kind of other point I would make on that is just so the audience maybe that doesn't know you personally or doesn't know your full story, I wouldn't be jumping around too much at first. Like you focused on the short term vacation rental portion of your portfolio and did that pretty much exclusively for a period of time, and then you moved into some of these other investments. And the reason I'm saying that is to really have the highest chances of success and to be as efficient with your dollars as possible, building out a team and just being very, dialed in with your approach. So rather
Yeah.
than doing, one short-term rental and then jumping over and doing a totally different thing with a long-term, just being able to really understand 100% what it is that you're doing. And that only way you're going to do that is through getting some reps,
Mm.
getting involved in just one lane initially and having that vision before ever jumping into that lane and understanding kind of that timeline of how long you want to be doing that for.
Yeah, that's a great point because regardless of your strategy, you really need to have a team. And you and I talk about how important that is, but I don't hear a lot of the things on social media. That's one of the things that doesn't always come up. And especially, the investing that I do is a lot of it is out of state. So I'm really reliant on other people on the team. And you're absolutely right. When I was building out my short-term vacation rental, those properties in Arizona, that was not, a 1 or 2 month thing. That was a 4 or 5 year thing. And so that's where we started. Now we have an incredible team built out down there, from property managers to pool people to handymen to roofers, electricians. If there's any concern whatsoever, we have a full network. And that's what I tell individuals. You have to have a network built out if you're going to be investing, especially if it's out of state. But a great strategy is to find someone who already is investing and already does have a network built out, and then that way you can plug right into their network. They
Mhm.
already have all the relationships built, and so that's what is attractive from that perspective. And then yeah, and then eventually I moved over into the long term market. But I would agree with you 100%. You don't want to be doing like one thing in this city, and then go buy something else in another state. You want to really identify a market that you can start to build some momentum. And and that is a conversation that you want to have with yourself. What are my goals? Not just with what type of property and what type of strategy, but do I see myself buying one unit? Do I see myself buying multiple units? How long am I going to be in buying mode? You want to ask yourself some of those questions.
Mhm. Yeah, and when I say, short term versus long term, you went kind of the direction of just the short term rental versus like a mid or a long term rental. But there's also the short term concept of just how long you're physically going to own that investment property. Some people are more on the fix and flip side where they're trying to, find a distressed property, buy it, fix it up over 3 months, and then immediately try and sell it. That's a whole other path that we could be going down. Again, just really having that clear understanding before ever even starting to seriously look for what type of properties you might be looking at buying, just really understanding this way, way, way ahead of time. So you
Mhm.
don't find yourself potentially over leveraged where you're completely in one thing and you can't get out, or, you just make sure that you're educated when it comes to, figuring out what direction you want to go with it.
Yeah, and the reason that's so important is because these other steps that we're gonna talk about, it can really have an incredible impact on those. The financing, how, if you're someone that's gonna go buy and flip a property, well, your financing strategy is gonna be very different than the person that is looking to do a buy and hold.
Yep.
And the type of team that you need is gonna be very different if you're looking to improve a property and sell it versus a short-term vacation rental versus a long-term. That is why it's so important to identify upfront what is my strategy. And then from there, once you have that first step as far as what strategy am I going to use, it'll provide some clarity on some of those other important things as far as financing, contracting, networking, and everything else.
So, guys, I'd love just to share one book that I think would be good for anybody that's wanting to just dive a little bit deeper into this. And that's, a community actually more than just a book, but it's called Bigger Pockets. And that was kind of a network that I tried to plug myself into several years ago. And one of the, not the founder, but one of the kind of the main spokespeople of Bigger Pockets, his name is Brandon Turner. He's got a couple really good books you can find on Amazon that are very simplified and just dumbed down to, anybody that, even if you have zero experience in this, you're able to still kind of comprehend a lot of the points that they make. And I think that's just a really good starting point. They've got a really good podcast as well if you're more of an auditory type learner rather than reading. But definitely look into Bigger Pockets if you're somebody that wants just to, start to get a little bit more knowledge and understanding of this really, I think, profitable and very advantageous style of investing.
That's right. The education piece is so important, and there's a lot of great books out there, great podcasts, and I love to read. I love to learn. And another great way to learn is just by setting yourself up on a search in a market that you're interested in. In fact, that's what I will do. I will just set myself up on a search for a property, for a market that I'm considering buying in, just so I can start to see what type of properties are available. And that way, the benefit of that is you really get to know the market. You get to know what type of properties are out there and how far your dollar will go. And then you also start to learn how much could I possibly rent this for? What could I acquire it for? How much is it going to cost to improve? So there's so many different ways to learn. I think as a real estate investor, one thing that's important though is that you need to always be learning and willing to educate yourself.
Love it. So, guys, you definitely want to stick around for our next episode. We're going to go into really deep down in depth about just researching different markets, really trying to identify from that 10,000 foot view, what areas that you might want to start considering. And then we're also going to talk a little bit more about financing, which is one of Ben's specialties. So, look forward to sharing those on the next episode. Again, going more and more in depth with practical tips and knowledge where you guys can actually take action and hopefully take a step in your own personal journey towards building wealth through real estate investing.
All right. Well, everyone, thank you so much for joining us. This is Ben Adams signing off for Adam Lang on the Pursuit of Progress podcast. Have a great week.